Welcome to the chase. You know, we're all running this race. We're all trying to claim victory in it. In my job, I get to sit down with wealthy people all week long. I hear about their wins, I hear about their losses, and quite frankly, like a bartender, I hear about their heartache. And I don't want you to run that type of race, or at least I want you to succeed at the race that you're running, and I want you to succeed at something that matters. Think about it like this. All the while you're chasing after something that's good, God's chasing you with something great.
Well, hello, this is Chris McAlpin with Sound Financial Strategies and your host of The Chase. Our goal is to give you excellent economic updates, excellent market news and data, and speak some truth into that as well, so that you can reach your financial goals. So our whole goal in this show is we want you to be financially independent. Foremost so, I want you to be able to live without the rat race that our society puts on money, without the financial stress, without the financial worries, without the ups and downs. And hey, we look at a world that just looks like it's going to hell in a handbasket. But that's why we want to look at the financial world through a biblical lens, because God's truth gives us a place to be able to honestly look at truth, to be able to see lies, to be able to see half-truths, to be able to see how this affects us and how this shapes us, and to be able to say, okay, God has blessed you. He's blessed me with a certain amount of resources and a certain amount of opportunities and these relationships, also that they can to shape our lives so that we can live generously. We can enjoy the blessings he's given us, and we can invest in our future. So that's what our shows are about. And so listen, if you like this, remember, subscribe, ring the bell, follow us, listen to us wherever you listen to podcasts. Go find us there. Write us a review. Tell us what you think. Ask us questions. We'd love to talk with you and be able to answer those questions. So we've got all kinds of market explosions going on around us. And the stock market took this big giant nosedive to start the year. And then we get this whipsaw like a slingshot coming straight back up into the end of the quarter. Now, the big question is this the start of a new rally? And are we off to the races? Or is this a bear trap? And to help me answer this, I've got my good friend, Clint Sorenson, the Chief Investment Officer of WealthShield, also the lead investment strategist of Sound Financial. And so as we think about this, and as Clint is on the show with me, a financial advisor's job is to sit down with a client and diagnose and determine that client's financial goals and understand their obstacles, understand their desires and their emotions, and shape plans to take action in reaching those financial goals. A portfolio manager's job is to look at the economy, look at the markets, to dive into research and study and shape and build investment models to help that advisor, help that client reach their financial goals. And so today, I'm going to have my financial advisor hat on, and Clint's going to have his portfolio manager hat on, and you're going to see what a real argument and a real conversation is like. Because I am going to ask my good friend questions that you, our clients, ask us. And Clint, how are you, by the way, my man?
I'm great, Chris. Thank you. Thank you for having me.
Right, that's right. And this conversation today would be a little bit different if we were having it last Friday, wouldn't it?
That's right. Could be a whole lot
bit different after four standard deviation moves in the bond market, craziness like that. So here we go, buddy. Nice little rally this week. We get into a rebalance for all of our clients. We rebalanced yesterday coming into the end of the quarter. You'll see all of those statements coming through, all of those trade notifications coming through email and via snail mail. But now, Clint, my big question just coming straight out of the gate. When the markets go down, my investments go down. But when they come back up, my investments don't feel like they come back up as much. Why?
Yeah, I mean, I think that's a great question. It happens all the time, right? I mean, I think what happens when you have any type of regime change, which is what we're dealing with today. So if you're just to rewind, remember when we talked early on, I think it was late last year, early on this year, talked a lot about, hey, what's this 2022 outlook kind of look like? What are we facing? We talked about the Fed dilemma. Fed dilemma was we were facing a slowing economic environment. And that slowing economic environment was going to involve higher than average inflation, which could possibly stay higher for longer. And that was going to force the Fed to either A, prioritize inflation and kill the economy, or B, prioritize growth and potentially have higher inflation. So you're kind of facing this great pickle. And we talked about the potential pitfalls of that. Well, then you sprinkle in a Russia invasion in Ukraine, further pressure on raw material prices, higher inflation globally, and now a more aggressive Fed, and you've got the perfect recipe for fireworks. So we saw all this kind of materialize. And what was really interesting is this materialized a lot earlier than we thought, because the growth data was not supposed, and it's just math. We're just looking at the data. This is not a prognostication. This is simply year over year math on growth, and in particular, leading economic indicators. And what we saw is we saw this happen when we were looking at the math. It was supposed to happen in the second quarter and really be kind of the back end of the second quarter where we'd really see the bad data. And we thought, hey, that's where the probability suggests we could have a tough market. And so what happened is you got this early rush down. Portfolios were positioned not for a rush down. They did have defensive mechanisms, but the way portfolios work and our portfolios work is we adjust and respond to that information to adjust the portfolio. So you had this quick move down, markets got really oversold. The key ingredient that didn't help was, even though we made moves, we raised on January 27th, we started moving a good portion of the fixed income portfolio to cash and cash equivalents. Problem was the whole bond market went down. So you had pretty aggressive, even though that was defensive, you had a pretty aggressive move down in defensive assets. Now, this happens from time to time, and in particular in inflationary regimes, when the whole bond market has to price in the Fed moving aggressive against inflation. Likely, that is just a temporary thing. And so what happens historically is you get a move down in the bond market, right? A shock to the bond market system. It feels like, oh my goodness, everything's kind of moving together. But then you start to get things that kind of find their footing. And typically those defensive assets in a continued move down tend to be the benefactors of that continued movement. So that snapshot view of just looking at it over a quarter, right? That's when you will get those moments from time to time. You'll get those moments of correlation where both stocks and bonds are down, both offensive assets and defensive assets are down, and it happens. And so what I always say in those environments is zoom out. Let's look at the bigger picture. Let's look at where we are. How are we positioned? Are we offensive or defensive?
And that, let's before we zoom out, and because I'm going to ask a question almost for our clients, and we'll say let's go specifically to the models in just a minute. But if I own a bond, and the daily bond price goes down because of market movement, when that bond reaches its par value, I get paid my money back, correct?
That's right.
Right. So shouldn't that be the same type of flow through an ETF as well? Not exactly the same, doesn't report exactly the same, but we should still see the same types of results, even if the bond market sells off, that we should see it come back up by nature of how bonds work. And in the meantime, we are making a bond yield. Isn't that correct?
That's correct.
So you're still confident about what we're seeing in defensive assets on the bond side, right?
Oh yeah. I mean, in equities too, leadership is still firmly in the defensive camp. You just had one of those moments in time where you had to adjust to a new reality, and it was a fast new reality. And that reality was, we've had a punch bowl, right? We've had stimulus. And to remind everybody how massive the stimulus has been, beginning of 2008, it was 890 billion. It's 8.9 trillion today. So that is a lot of fuel for a fire. And we had a fire.
All right, Clint, let's get back to what are we seeing in the world? You were on the bond market. What's up?
Yeah. So you had the MOVE index, which is a measure of treasury volatility. So think about it like the volatility index for the S&P. You probably heard it called the VIX, right? The VIX index, which is the volatility index for the S&P. That MOVE index rocket shipped higher as you started to have to price in higher than longer inflation, right? Because coming into the year before an invasion, the math was pretty clear. Inflation would moderate over time till about February next year, where it would go from 8% to about, call it 4% by February of 2023 because of the calculation. CPI is measured year over year. CPI is also a little messed up because it doesn't include house prices in that component of the calculation. It uses owner occupied rents. That means, Chris, you own a home. I ask you what you'd rent your home for. You don't do any research. You just answer the survey. And you say, I don't know, 4%. That is not a really accurate measure, but that's what we have. That's the data. And so when we looked at the year-over-year math, the way they measure it, you could see it moderating, starting really calling it the third quarter and moderating down through the course of the early part of next year, which is as far as we have data, because you can measure.
So has Russia, Ukraine wrecked that bad? I mean, I know they're the breadbasket of the world, but is that where you're going with that? Is that,
well, think
Russia,
about the biggest component. Yeah, the biggest
wrecked
component
inflation that bad?
Yeah, think about the biggest component of inflation as it relates to the consumer. Guess what
Energy
it is?
Food.
Yeah, energy and food. And when all of a sudden you start cutting off fertilizer shipments, you start cutting off, and energy has a shock to the supply system. Right after we had a supply shock in the global pandemic, where we turned the light switch of the economy off back on and then dumped a bunch of money on people. Like you when you do those type of things, you create shocks, and those shocks create this type of contagion that we witnessed. And so it's kind of this perfect condition. The problem is, Chris, is that this is all happening in a slowing economy, and the people haven't realized how bad that is going to get. The ECRI, which is the Economic Cycle Research Institute's weekly leading index, their proprietary growth rate went negative last week. Negative. That is typically indicative of a market that's in a severe economy that's in a severe slowdown or a contraction. And when you look back at their track record, it has been pretty accurate in terms of leading contraction. So you've got this slowing growth environment.
So that ECRI, leading economic indicators, I mean, if that is year over year negative from last year, though, isn't that a mathematical almost a requirement because of how high the economy was last year due to its year over year from 20 to 21? I mean, aren't we kind of riding a roller coaster on that mathematically? And does that paint the real picture?
We should have been by second quarter, at the end of the second quarter. Yes, not early in the first quarter. And then when you look at consumer confidence, so what you've had a collapse in consumer confidence. Michigan Consumer Confidence or Consumer Sentiment Report is at 2009 levels. The OECD is right around 2009 to 2010 levels. The number one thing they're highlighting is inflation. It is detrimental to consumption. Consumption as the U.S. economy is 70 to 90%, depends on the year you look at, but on average about 70% of what we produce as a country when you look at gross domestic product. So this is amazing. And at the same time this is happening, the Fed since 2008 has done nothing but stimulate and blow up bubbles. Anytime it pops, it blows it up. It adds more fuel to the fire. We can go back through and just look at the times where we've had slowdowns, right? Slowdown in 2011, really led by what was going on in Greece and the EU. What did the Fed do? Launch QE2, right? What happened in 2015, 16? The whole globe went to negative interest rates. Another slowdown. 2018 into 2019, the Fed, Jerome Powell at that time, after he raised rates 3 times, stops, reverses course, cuts interest rates 3 times. And then in 2020, in the contraction, doubled the Fed's balance sheet, not to mention partner with the Treasury to expand the range of assets they bought. The Fed has done nothing but stimulate. And then they sit back and they say, oh, now we have inflation and we're going to prioritize inflation, which means they are going to kill demand in order to do that, because they are going to take away.
I mean, isn't it time to pay the piper? I mean, is that way the Fed's going to act about this, that it's time to pay the piper?
But can they? Will that work is my question, because now we're in a geopolitical situation.
Answer that first question first. Do you think that they will? Because it kind of doesn't matter. It doesn't matter what we think they should do. What do you think they will do?
I think they will raise rates 50 basis points this next time. And then I think if there is some sort of major negative market event, which would line up with a major growth scare this quarter, I do believe they will walk that back. I think they will stop hikes because that's what they've done in the past. However, it's a very difficult dilemma because you're in a midterm election year. Consumers who vote are not happy because of inflation. And if you have a Fed that stops and starts having to stimulate again to support the markets and growth, you could have a real mess on your hands. And Jerome Powell would most likely be out of a job. So this is a really,
how much do you really think he cares about getting in and out of a job?
I don't know. I don't know what he cares about.
I mean,
All I know
if
is
I'm
he's
in
not
his, if
data
I'm in his,
informed.
if I'm in his shoes, I really want to do the best job I can. I really, really don't care if I get fired. It's not like he's not going to get hired next week, and he's not going to miss. He's not going to miss making the rent payment. Okay.
Yeah, well, when an environment where you're starting to get countries stepping away from the U.S. dollar and the separation in the settlement of trade, and in particular gas and oil trade, including Germany, a member of NATO, is now settling oil or gas trade in rubles. Rubles, folks. Think
But
about that.
is that just because they have no choice at the moment? That's as much of their own stupid political moves in the last 2 decades
I agree. I mean,
as
cutting off
that
all
is. I
nuclear,
don't think
what?
that's a negative against the dollar. I
A
think
huge
that is
negative.
negative against their own geopolitical machinations. I think that the stupidity of them continuing to be as anchored to Russia from an energy wise, they've never been friends. Is that
You
really a negative on the U.S. though?
Yes, because you are disrupting the current world order where the US dollar dominates the settlement of trade. NATO is there to defend the dollar. We have always defended the dollar, always by military might. And all of a sudden, you're potentially alienating a key member of NATO and a key member of the EU who has now decided to not say that they're sidestepping sanctions, but to essentially do it without saying it. And they are going to settle trade in rubles. And then you got to look at the fact that their largest consumer is China. And so now you can start to play out these scenarios where China, Russia start to take a bigger role, right, in terms of global trade and that settlement outside the dollar. And this has been happening. Bloomberg had a report. It's now only 59% or something. It used to be way higher, like in the high 70% in terms of settlement in US dollar. You've had a major move away from settlement of trade in the dollar. And that is a profound problem for the Fed. Because why? Because when you're settling trade in the dollar, everyone is hinged on the US, the Fed's monetary policy. And the moment we start to walk back and shake confidence, you only potentially accelerate that trend further. And when you accelerate that trend further, now you're talking about what President Biden said in the speech this year, a new world order. And that new world order has these other players playing a bigger role.
So let's talk about, because none of that, we cannot control any of that. I've had a couple of client meetings today, and we talked about this. I said the number one thing I tell someone to do in a financial plan: recognize your relationships, your resources, and your opportunities. You have good relationships to help you take advantage of your resources and opportunities. Number two, control what you can control. We control none of that. The reason I asked the question about the Fed is mainly because you just don't fight against them. We still live inside of the United States. The United States dollar is still the reserve currency of the world. We still do business in the dollar around the world. And I'm not sticking my head in the sand and say what can happen in the future, but I think that Germany is probably playing a game that they must play to keep their people fed, cool, and warm. I mean,
and this pickle makes it difficult for the Fed to backtrack. So now they kind of have to go after inflation, right? Because if they backtrack, you're going to potentially shake confidence in the dollar. That's the whole point. It's not about Germany or the other countries. It's saying, hey, there's a lot of things happening geopolitically, which make it very difficult. So you have high inflation, you have a slowing economy, you have a Fed that said they're going to tighten. In fact, JP Morgan came out this week and said they're going to do 2 50 basis point rate hikes consecutively. That is and we already have an inverted yield curve, meaning the short-term rates are higher than long-term rates. And
but let's take this back and say, okay, in the bond markets, in the stock markets, what are we actually seeing that our listeners can do something with? How should we view this in our actual models? Because we can't do anything about any of this. But we must know it so that we can manage around it. But that's your job. I'm gonna go back and we'll put my advisor hat on, put your PM hat on, and I'm gonna say, okay, build me a model that I can take to my clients and that they can reach their financial goals, and we can weather the short-term storm, because this storm's not going to last forever. Okay. And then you and I've talked about it. We actually put it on one of our shows. There's a small chance we get in a hot war, large chance we end up in a cold war. U.S., NATO, the Anglosphere versus Russia, China, right? Pretty good shot at that one.
Yeah.
And so what do we do dealing with inflation, dealing with rising interest rates? And listen, folks, we've been here before. It sounds like 1970 and 1980. That's what this sounds like.
1962 to 1982 is a perfect environment to examine.
We can look at history. We can kind of make a decision about what to do today and going on in the future. So what do you say to that?
Yeah, so I agree. And again, when we talk about these scenarios, we're really trying to identify where are we now? I'm not really concerned. I can't be concerned with trying to predict the exact direction. I'm trying to take all the information in and say, are we in a Cold War now? Are we in this move away from the dollar now? And are these trends evident? And they are. And so the key thing I always say is to stay disciplined to a process. And right now, during regime change, if you look about when trend following really has dominated historically, it's been in these big regime changes. It's been in a shift from back during the 1962-82 period. You went from a hard money system in terms of the gold-backed US dollar to a fiat money system in 1971. That period was incredible. Yes, we had inflation coming off the back of that. That inflationary regime shift took kind of the current situation and moved it. And all of a sudden, that kind of set up for a really rocky environment. You know, if you invested $1 in the S&P 500 in 1962, so January 1, 1962, including dividends and with inflation, so real return, that dollar grew by about 0.68% per year. So that's roughly like $1 to $1.17. But for 20 years, that was your average rate of return. And look at the ride you had to go on. It was probably one of the most volatile rides we have witnessed. But you know what did well? Trend followers, people who said, you know what, I can't predict. What I'm going to do is just buy strength, sell weakness. And that's exactly what we've done in portfolios. So if you look back at actions, we had a good chunk in trend following. Yes, it was in the fixed income market, but it went a good portion of that into cash early in the year as markets started to adjust to these realities. We didn't need to predict it, right? We didn't have to say, oh, I think we're going to go into a hot war in Ukraine. We just said, hey, something's happening and we're going to react because there's weakness, and the strength is now with cash. So we moved into cash for a portion of assets. Then what has happened now is we got this nice bounce to rebalance portfolios more into trend following, and as well as adding quality and other factors that tend to work well in a what I call an economic slowdown regime. So we're just following the data, adjusting to that data, and then positioning portfolios with that. But if you look across models, trend following is by far our biggest philosophical alignment. Because let's talk about what is trend following, right? Other than buying strength, selling weakness, what am I really trying to do? As an investor, we're all loss averse, meaning the pain in Daniel Kahneman, Amos Tversky, Thinking Fast and Slow. This has been documented so many times. But if you look at loss aversion, what it means is that the pain of loss is felt 2 times the pleasure of gain. And because of that asymmetry, right? Investors want to do anything to keep from losses. What trend following does is it takes losses quickly. It's completely counterintuitive. So a good trend following system, I know we've talked about this on your show before, but a good trend following system is accurate. So it's right 30 to 50% of the time. That's how accurate it is. It's going to be wrong.
Back to something. Let's go back before we get to that, because that right there, those two points together, we need to for the listeners to hear that, is that people feel the pain of loss 2 times more than the pleasure of gain. And there's a ton of studies that support this. You're exactly right. But I see that when I'm meeting with clients all the time, that it's you even ask a question and you get this kind of cringing look when you're talking about losses. Because one of the rules I talk about in fitting models, a client must fit their risk. We must have someone understand how their models, how their portfolio is going to behave so that they can put themselves inside of it and feel that up and down. Feel that loss so that you can go chase the gain. Because you can look at a model and it tested out historically and it made 8% a year, 12% a year, 10% a year, something like that. All right. And everybody goes, ooh, give me that 12. Okay. You could probably call his name, but there's a great hedge fund manager. He averaged like a 16% for decades.
Yeah. Bill Dunn.
Yeah. Who?
Bill Dunn.
It's Bill Dunn. Yeah, magical trend follower there.
Yeah.
But he had a truckload of 35% plus losses. Most people just can't stomach that.
Right.
So it's you don't have to get a 16% a year to be successful. In fact, most of you are not going to get that. Okay. But you need a portfolio that is going to get you to your goals, and you need to feel that risk so that you can ride that out. Make that decision in advance that this is where I can stomach my losses to earn the gains that I need. It's not a game of chicken, and it's not a game to be played with your ego, you know? Right. And I think far too often we kind of get sucked into that. So people won't accept the loss, to your point, the second one you're about to make. You go get those losses fast. How do you do that? Why do you do that?
Yeah, because you do that because what you want is you really are trying to play a game when you're investing of survival. That's what trend following ultimately is all about. It's about surviving long enough to capture the big wave, right? So it's, if you're surfing, you're out in the ocean, you're taking every little wave because you don't know which one will be the big one. So you're just taking every wave and you're going back out there. And at the end of the day in investing, it's all about avoiding that major problem to the downside, right? Avoiding that, the major catastrophic losses, right? Which happen about, a fifth of the time when you look at the average stock, right? So 1 out of 5 stocks loses about 75% of its value. You typically don't recover from that. It takes a 300% gain to get back to even.
Yeah. You want to cut those out.
Cut those out. So you cut your losses quickly. So you take small losses, but your winners you let run. That is trend following. And when you let your winners run, you don't know when to take profits. You take profits based on your system of exiting, which is a stop loss system or a rules-based system to exit it. Yeah. That is the key. It's about survival. And that's why I love incorporating enduring regime changes to diversify by a few different things, not only asset class, stocks, bonds, commodities, real estate, private equity, whatever, but also to diversify by what I call system or strategy. And one of the best ways to do that is to incorporate, in my opinion, is to incorporate trend following, because I don't have to get it. I don't have to know if Xi is going to negotiate peace and there's going to be a ceasefire in Ukraine. I don't have to worry about all that. All I have to do is take data and adjust.
Take data and adjust. And we talk about that a lot, that it's just run by math formulas. Take data, run it through the math formula and adjust. And we're not trying to predict the future. We're just trying to move with what the markets give us. Yeah. So we talked about bonds. I want to wrap up that point. Then I want to give you a quote, and we're going to talk about this a minute. So bonds, even our dynamic fixed income got hammered last week. Just one of our models that's the name that we have for it together. And I asked you the question. We had even moved risk off. What in the world happened to that? And I was giving you a lot of grief about it last Friday, but we had a 4 standard deviation. I met with a client today that is a math professor. We had it's like statistically, there's really no such thing as a 4 standard deviation move. I mean, not supposed to be anyway.
Not a normal distribution.
Not a normal distribution curve. No, but we've had almost market capitulation. Would you say it was market capitulation in the bond market? That last ditch temper tantrum, and then coming into the last week of March, we actually saw some good movement in the bond market in the positive direction. So this is as much of the massive amounts of money that's just sloshing around our economy due to the pandemic and the shutting downs of the economy. I mean, there's a lot more technical explanation, but at the end of the day, isn't that as much the cause of it?
I mean, it always comes down to the Fed and being the last buyer of bonds. And then all of a sudden they're telling you they're going to stop doing this.
They're done. Yeah.
And that's a binary decision. Okay. So you get volatility
reactions. Yeah. And at the end of the day, and we do, you and I both, I mean, we do know interest rates need to go up and that they need to reset some of this. I mean, there needs to be a reset. We just gotta work our way through it in managing portfolios and managing clients' financial plans. So I'm gonna quote this. I'm gonna read this quote to you, and I'm gonna ask you a question. So Charles Dickens wrote this, right? It was the best of times. It was the worst of times. It was the age of wisdom. It was the age of foolishness. It was the epoch of belief. It was the epoch incredulity. It was the season of light, it was the season of darkness, it was the spring of hope, it was the winter of despair. A tale of two cities. So you made a statement in our conversation. Stocks look like the year 2000, bonds look like the year 2008. Won't you explain that and which one's going to win?
Yeah, I mean, so typically this has everything to do with the cycle. So, a big part of our work is just paying attention, measuring data, and figuring out where we are in the economic cycle. And what we know is when we get high valuations, you get high inflation, and you get a Fed tightening. So that's why the Fed's always a component of our framework. And then you get an economic cycle slowing and trends deteriorating. We have all of those things. We have record high valuations. If you look at the Warren Buffett indicator, which is called the market cap to GDP, we're the highest ever. We're over three standard deviations above fair value, right? If you look at market trends, we've deteriorated pretty significantly where there's defensive leadership among sectors, industry groups, et cetera, with the exception of energy. You also have deterioration in a lot of intermarket relationships that suggest that defensive assets are winning. You can look at home builders falling to new lows relative to stocks. You can look at semiconductors dropping relative to the broad market. You can look at staples leading relative to the broad market, gold outperforming stocks. There's a ton of different things you can look at. Utilities, I already mentioned, utilities outperforming stocks. So you're seeing this defensive leadership in the equity market that suggests that this is all a reality. And then you pair that with the fact that the economic growth cycle is in a pretty aggressive slowdown and is only going to get worse mathematically. You still have economic surprises to the high side right now. And the worst part of the data doesn't get reported until the third quarter for the second quarter. So year-over-year math, which seems so easy to you and I because we pay attention to, is not easy to most market participants. They wake up one day and see a bad print and all of a sudden they're selling. It's not
I'm
you've
so
been
sick of that too.
Yeah, you've been out of the matrix for so long.
And then the newspapers on the afternoon, they go the news cycle, they go find something.
Yeah, wheel of
days old and go flash.
Like I said, you've been out of the matrix so long, and we get this a lot, right? When I talk to our colleagues that we work with, right, in my investment team, they're like, "But it's so easy to see." I'm like, "Yeah, because you're out of the matrix, paying attention to the data." Most people aren't. And so I was just looking at CNBC and I was trying to just surf for a lot of sentiment. And you see Jim Cramer on there saying the bear market's over. How does he know? I don't know. When I look at the data, it does not tell me that it's over. It tells me that you still need to be defensive. Economic cycle, high inflation, geopolitical conflict, potentially making that stickier for longer, a Fed tightening and record high valuations and deteriorating trends. That all tells me to be defensive. If that changes and says, let's get back offensive, we should celebrate, because I'm a big believer that the future is going to be brighter. Decentralization trends, technological changes, life extension technology. And this is an awesome time to be alive. It is by far it's awesome to get up in the morning, live life. But like that quote, you've also got the other side you have to pay attention to. And so ultimately,
I think that's a great point. Just like we see in the world, we see a lot of good things, generous people, fulfilling careers, awesome opportunities. And we do see a lot of darkness. We see a lot of foolishness. We see a lot of just absolute stupidity. I think we see so much of it that we've become pretty jaded and pretty thick-skinned. And we forget to sometimes go, no, that's actually stupid and you shouldn't do that. Yeah. But to your point of somebody that's even in the matrix and they wake up, I think that's a lot of investors. And one of the reasons that we want to talk about on this show, to be able to bring this up and say, have peace, live life. There's a lot of goodness going on. Don't get sucked into this day-to-day angsty mess when it comes to the market. It's Jim Cramer's job to ring bells and press buzzers and yell really loud and roll his sleeves up. I kind of look like myself, like looking at the screen here. Maybe it's my job to do the same thing. That I'll have to get a bell and start, maybe on the Mississippi State cowbell.
Sound effect.
Yeah, and do hotty toddy at the same time. It'd be kind of funny. But I think that we forget that the people that are on the news, it is their job to sell the news, and blood sells. to your point, Jim Cramer does not know when the bear market's over any more than you or I do. He's looking at the same data we are. It's not any smarter or dumber than we are. We don't know. We say this often on the show. The future and predicting it and managing it and knowing it, that is the almighty space. That's not ours. I don't know what it's going to do at all.
Nope. And the good thing is all you have to do is have a plan for reacting to the information as you get it. And if you pay attention, you're awake, you get the information, you react to it, right? If the market tells you to put the offense on the field, you put the offense on the field. Chris, you played football. Yes, you played defense, not you personally, but your team had a defensive squad, right?
Yeah, absolutely. We played defense, played offense, played special teams. When it was time to play any of the three, you played all three.
Just like a car has a brake and an accelerator, right? And airbags and seatbelts. It's the same way in investing. You have to have both. And just because you play defense doesn't mean you're bearish and negative. Look, it's just saying, hey, the data, the trends, the Fed, the valuations, the policy, or the economic cycle, they're all telling me the same thing. Play defense. If the market goes to new highs, rocket ships up 100%, great. That's why we diversify and we'll rotate there. But at the end of the day, it tells me to play defense. And until I've got the signals and the playbook to put the offense back on the field, that's what we're going to play. Right. And I think that is the beauty about having not an ego preservation portfolio, but a responsive, data-informed, rules-based portfolio. Because what it is it's all about that survival. It's all about capturing the big regime shifts and changes. And we could possibly be living in one. And Chris, we've talked about this privately. This could be one of the greatest opportunities for wealth creation and also one of the greatest pitfalls of wealth destruction. And again, it goes back to your quotes, the tale of two cities. And so what we've got is our job is to find those opportunities and avoid the pitfalls. And the best way I know how to do that in such a rapidly changing world is to pay attention to data, build a rules-based framework, and follow it with discipline without wavering. And yes, there's going to be times where it's not right. In fact, you can count on half the time it's not going to be right. Even though we come on here and we sound so great because we say the economy is slowing, we're reporting the news at that time. Right?
We are.
That's all we're doing is reporting market data. But at the end of the day, from a portfolio execution perspective, we're going to be wrong just as much as we're right. But if we manage risk well and we capture those big trends, then our clients, it's about the ride, which is what you talked about. It's about smoothing that ride so they don't abandon the portfolio at the wrong time and they allow time to work in their favor to compound money. This could be a 62 to 82 where if you bought and held the S&P, you compounded, something that rhymes with hero, or it could be 82 to 2000 where you have a rocket ship growth rate. Who knows? But we want to participate and play the game, and it's an awesome thing to do.
And you and I've read a truckload of books about a lot of people who created wealth in both of those time frames.
Oh, both of them. Think about some of the greatest names.
Some of the greatest investors we study today grew up then.
Yeah, think about in 2008 too. Everybody's like, when you ask 2008 word association, most people think, oh, housing crisis, global financial crisis, on the brink of collapse. You know what I think of? I remember Kyle Bass, John Paulson, right? Some of the trend followers, CTAs, people making and trend followers making a lot of money in that environment. You don't always have to look at it as the cataclysm or the apocalyptic message of the moment. Sometimes you have to look at it from the opportunity perspective. And again, if we stay focused on the ride for our clients, not the S&P, not even the bond market, but we focus on smoothing that ride, meaning, yes, we're going to have losses, but our goal is to make them small. Yes, we're going to have gains and they're to be hopefully 2 to 3 times the size of our average loss. And if we do that over a period of time, our clients are going to be happy. They're going to compound, and we're going to have a smooth ride portfolio for them to celebrate and reach their goals.
That's right. So let's close with that. And you and I will talk about this a lot more through the spring. We'll keep you on the show with me, and let's kick these around a lot more. I think we're going to have a lot more to talk about because we want our listeners reaching their financial goals.
Love it.
Thank you. Doesn't all this feel confusing? And, this idea that the world's going to hell in a handbasket. It's as if we're watching it burn many times before our eyes. And it's at the same time, as Clint and I were just talking about, that it's like the Tale of Two Cities quote, that we see this good, we see these great opportunities, we have all these great resources. I mean, what a great time to be alive. Whether you're retired or you're just starting your career, you've got wonderful opportunities in front of you. But Paul wrote this to the church in Corinth. I love this verse. It says, God is not a God of confusion. He's not a God of disorder, but he's a God of peace. And as written in 1 Corinthians 14:33, the craziness of this world is not from God. The wickedness, the bentness, the brokenness, the destruction, that's not from God. The confusion, the worry, the angst, that's not from God. I don't care what your favorite news station tells you. I don't care what your political party tells you. This confusion, this brokenness in the world, it's not good. It's not for God. And God loves you. God's blessed you. He offers us peace. He offers us freedom. He offers us stability, and our finances are included. And I think that's the biggest reason that we started this show originally, or one of the biggest reasons, is that God has so much to say in his word about our money. And he has so much to say in his word about our peace and stability and our financial lives, because our provision is wrapped up in his promises. Not to be materialistic, not to be greedy, not to be arrogant, not to be fat and luxuriant, but it's to be satisfied and both ambitious and content at the same time. And so how do all these statements, how everything that we're talking about affect you and affect your finances? So here's three things I want you to do and think about. Recognize your relationships, your resources, and your opportunities. You are blessed. Work to take advantage of this. Number two, control what you can control. Now, yes, know the news, but don't get bent out of shape about the news. Know it, recognize truth, recognize the data that you need to recognize, and utilize it in your life, and discard the rest. And number three, think, pray. I call it just kind of thinking and praying at the same time. Just kind of roll an idea over and just trusting God to guide you. Plan and act. Think about what you're doing and act well. Above all, trust God and not your money. Here's a couple of practical things, because I'm hearing this a lot. I'm hearing more and more. Gas and milk are $3 a gallon. Loaf of bread's $8. Yes, prices are going up and they are going to go higher. There's no doubt about it. And we've not experienced inflation. We haven't experienced inflation at all in 2 decades. We haven't experienced 8% kind of rates in 4 decades. And so what can you control? I think about it like this, food, shelter, necessities. Okay. We can, if your budget really gets tight, you can cut out entertainment. You can cut out streaming, cut the TV off, turn the devices off. You don't need a new one. There's a lot that we can cut out in our lives and have a wonderful and joyful life. We actually sat down as a family last night and played a board game with 3 teenage daughters. I mean, it was as comical as it sounds like. And yes, they stopped. Yes, they put the phones down. Yes, they put the other devices down. And we just hung out as a family. It was a lot more fun than anything streaming on any of the stations that you can go and watch whatever you watch on. And so think about how your financial plan affects your life, how your goals, because that's a part of your survival, it's a part of your thriving, it's a part of your enjoyment. How does it affect your life? How are you planning and how are you shaping this? These seasons pass, they come and go. You can and should make big financial plans and big financial goals and less work to go get them. That's what this show is all about. So if you like what we're saying, you like what we're doing, write us a review. If you don't like it, hey, write us a review, tell me. I'd love to hear from you as well. Subscribe, ring a bell, follow us, and listen to us wherever you podcast, because we want to teach you and we want to encourage you to make great plans and take great action, okay? I want you to be a financial success. But remember this, all while you are chasing something good, God is chasing you with something great. Take care. God bless.
For disclosure and citation information, please go to www.soundfsg.com/disclosures.